Welcome back to Intelligent Investment Today, the podcast dedicated to all things value investment. In each episode, we take a look at a different issue from the financial landscape and attempt to use the lessons of the craft, as laid down by the man widely considered to be its founding father. Tutor and mentor to Warren Buffett, we're of course talking about Benjamin Graham. In this edition, we'll be taking a look at what is known in behavioural economics as the Lollapalooza effect, a term coined in 1995 by Buffett's former right-hand man at Berkshire Hathaway and legendary investor in his own right, the late great Charlie Munger. We will be considering what the effect is exactly using real-world examples, assess why understanding human psychology is so important for the investor, and the reasons keeping a vigilant lookout for the effect in action is a crucial aspect in the avoidance of steep investment losses. So without further ado, let's dive straight in. As always, buckle up, sit back and get ready to take on board another lesson as inspired by Benjamin Graham. When most of us think of the word Lollapalooza, we probably think of the annual American music festival. But the Lollapalooza effect is also what Charlie Munger chose to call a very special behavioural phenomenon that can oftentimes have a serious impact on markets and investors. The effect is a situation that sometimes arises in behavioural economics when a number of psychological factors that can affect the markets converge at the same time. Each of these factors might very well be benign in isolation, but collectively they can converge to offer up an amplified and outsized effect. A sort of shitstorm of irrational emotions, if you like, and this can prove disastrous to the unwary investor. These psychological factors that come into play can be easily seen during stock market bubbles, when investors have a tendency to get overexcited and push up stock prices to levels that are way out of line with reality. These bubbles do not occur because of any one single psychological factor, but rely on a number of them acting in unison, culminating in the perfect storm. The first psychological factor in play during these tumultuous periods of market excess is what the psychologists call social proof. This is the idea that under conditions of great stress and uncertainty, we look for guidance in the actions of others. Psychologists often use the example of Kitty Genovese, who was raped and murdered outside of her New York apartment in 1964, with around 40 bystanders failing to intervene. The idea being that everyone looked to everybody else for direction on how to respond, and when everybody else did precisely nothing, then this was deemed to be the correct form of behaviour for everybody else to follow. They walked by, leaving Kitty to her fate. In a frothy stock market, social proof also manifests itself with people looking to others for guidance on how to react to this very unusual situation of ever-rising stock prices. And when they discover others are buying stock, then the conclusion that is drawn is that the best course of action is surely that they should be doing so too. Linked to this is another psychological factor that comes into play during these periods, and that is the well-known concept of FOMO, or fear of missing out. We are all innately programmed as human beings to become uneasy during times of scarcity. Our very survival depends on the availability for food, for instance. So it's quite obvious where this instinct has arisen from in terms of evolution and natural selection. In the developed world, fortunately, most of us no longer have to worry about the scarcity of food, but the impulse has not completely disappeared from our psyche. It now just manifests itself onto first world commodities like stocks or Taylor Swift concert tickets. And whether it is stocks during a bull market or a particularly in-demand concert ticket, the roar of the crowd will be, "If I don't buy this now, I will miss out, and then I'll be worse off and so will my family." On top of this, we also have the factor of confirmation bias to take into account. This is where we as humans have a tendency to seek out and interpret information that confirms our already established beliefs. Why is it that whenever we're confronted by a person who has a particularly strongly held view or belief on a certain topic, you can always pretty quickly establish that more often than not, they will not have read an argument against their position, perhaps ever? Well, that is confirmation bias in action. In the world of stock market investment, this might mean that investors will actively seek out forums like Reddit to find groups that support their belief that they should be buying a certain business, probably at any price. And anything reporting bubble conditions will not be found, or if stumbled upon in error, that page quickly killed. We can also throw into the mix news bulletins reporting on new all-time high stock prices, and feel-good stories of ordinary people who have made millions on the stock market. And perhaps even your postman is telling you that now is the time to buy. And during these periods, we can't even rely on those people who actually know what they're talking about to offer us sound advice. Are stockbrokers whose commission and livelihood relies on the trading of stocks really going to have a quiet word with their clients advising them not to keep on buying? I mean, it might happen, and monkeys might fly out of my butt. Is it really any wonder then that the average person on the street, untrained and unknowledgeable on how the stock market operates, oblivious of previous market bubbles, and completely ignorant of the Lollapalooza effect, of course, can become overwhelmed by this deluge of psychological factors being forced down their throats? Everyone, everything is telling them to buy, so why wouldn't they buy? If I was in their boots, I would probably buy too. But as well as the layperson on the street, experienced investors are also susceptible to fall into the Lollapalooza's trap. It is all very well knowing about the dangers of a particular situation, but it is often easier said than done to react in the correct way when you come face to face with it. Everybody knows or should know the correct course of action when confronted by a grizzly bear in the forest is to hold your ground and stay calm. The moment you express fear or act like a prey animal, it's game over. But in reality, I suspect most of us, faced with this threat, would run as fast as they could in the opposite direction, while simultaneously calling out for their mummy. And can anybody be so sure that this is not what they would do if they came up against this very situation? As Mike Tyson was once claimed to have said, everybody's got a plan until they get punched in the face. So we can see that understanding human psychology is such a vital aspect of investing in the stock market. Only by being able to highlight all the individual factors that can combine to become such a potent and dangerous force can the investor guard against becoming a participant in this mayhem. It must always be remembered that with the Lollapalooza effect, each psychological factor, perhaps benign individually, combine to become a force far more dangerous than the sum of its component parts. And being on guard to spot clusters of factors building up simultaneously can allow us to prepare for what's coming. So where does this leave us as value investors specifically? Fortunately, one of the guiding principles of value investment can help us zone out from the cacophony of noise during bubble market conditions. And that guiding principle is that as value investors, we are not making decisions on whether to buy or sell based upon what we've read on some internet forum or been told about by the anchor of some news programme, or by anybody else for that matter. Our decisions as to whether to buy or sell will be based upon the information that we've deduced from the examination of the company's accounts. And whilst company accounts can deceive, they rarely lie. What you see is pretty much what you get. From the income account and the balance sheet history, an investor should be able to deduce to a reasonable degree of accuracy what should be paid for the stock of a business. By also baking in a margin of safety to ensure against small errors of judgment or unforeseen future developments, a value investor can feel pretty confident about whether a particular stock is being over or underpriced by the market. There should be absolutely no chance whatsoever, therefore, that an investor who has decided through examination of these accounts that a stock deserves to be selling for around $10, and after adding a margin of safety have decided that they are willing to pay $8 for that share, will entertain purchasing that stock at $15, at $30, or at $100. So if we are following the rules of the craft, then we are not going to get caught out by the Lollapalooza effect. The only risk that we face is becoming overcome by the barrage of psychological factors coming in from every direction. As the perfect storm descends, seeing everybody else making a fortune, we forget what we told ourselves we would do when faced with this very situation. And we start to do the worst thing possible. We start buying. And inevitably, sooner or later, you're going to be screaming out for your mummy once again. That is all we have for today's edition. I do hope that you've enjoyed it, and the lesson will act as one more piece of the jigsaw that allows you to become the best value investor you can be. If you've not already done so, please do consider adding to playlist. That way you'll be alerted as soon as any new episodes land. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.